Welcome to Iron Financial, the place you come to forge a stronger portfolio and cut right through all the market weakness. I'm your lead analyst. Today, we are putting Winnebago, ticker WGO, under the microscope. Now, this company just dropped a quarterly earnings report that seems to have caught Wall Street completely flat-footed, posting numbers that, well, on the surface, they look like the start of a major comeback. But here's the thing. The market isn't really buying it. Not yet. So the big question we're going to tackle today is pretty simple. Is this a genuine turnaround you can actually build a position on, or is this just a well-disguised trap for unsuspecting investors? We're here to tear it down piece by piece and give you the framework you need to make your own call.
Okay, let's just get right into the thick of it. You look at the headlines and the numbers look solid. I mean, Winnebago beat analyst expectations on both revenue and earnings, the top and bottom lines. They even paid down a huge $100 million chunk of debt. Now, these are the kinds of positive signals that in a normal world should send a stock absolutely soaring. But that's not what happened here, not even close. The market's reaction was muted. It was hesitant, almost suspicious, really. And that hesitation is the entire reason we're doing this deep dive today. See, when the numbers on the page say one thing, but the collective wisdom of the market, the actual price action, suggests something totally different, that's a massive signal that the real unvarnished story is buried somewhere deep in the filings. Our job today, we're going to grab a shovel and dig it up.
That's exactly right. I'm the market skeptic, and it's my job here to stress test these numbers and really challenge the hype. It's just so easy to get swept up in a single positive headline, right? But a real, durable investment thesis, the kind that actually builds wealth, has to be built on a foundation of solid steel, not just good feelings. We've all seen companies try this move before. They slap a fresh coat of paint on a crumbling structure, trying to lure people in right before it collapses. So, the question is simple. Is Winnebago truly rebuilding its business from the ground up, reinforcing the entire structure for long-term strength? Or are we just looking at a pretty cosmetic repair job, one that's cleverly designed to hide the deep structural cracks that are still lurking right beneath the surface? Today, we are going to find out. All right, so to get to the truth, we've structured our analysis to look at this company from every possible angle. First, we'll start by digging into the long-standing issues, what we're calling the cracks in the foundation. We have to do this to really understand the historical weakness that has plagued this stock. It's all about context. Then we're going to fire up what we're calling the turnaround engine to analyze the new numbers from this quarter that are driving the entire bull case. After that, we'll zoom out to see if this newfound strength is company-wide or if we're looking at a house divided, with some parts thriving while others are just dragging it down. From there, we'll examine their attempts at fortifying the balance sheet to see if their financial house is truly in order for the long haul. And finally, we'll look at the road ahead. We'll break down management's own guidance, and we will deliver our verdict. Let's get to it. Exactly. And before we get seduced by these shiny new numbers from this one quarter, it is absolutely critical, I can't stress this enough, that we understand the ground this company is built on. Because for years, that ground has been shaky at best. We have to examine the long-term structural weakness to have any real hope of understanding if this supposed turnaround is real. Ignoring the past, especially a difficult one, is just the fastest way to get burned by the future. So let's start by looking at the immense pressure this company has been under, not just for a quarter, but for years on end. And look, don't just take my word for it. This, right here, this is a direct quote from Winnebago's own 10Q filing from mid-2025. This isn't some analyst's hot take or a sensational media headline. This is the company itself, admitting in its own carefully chosen, lawyer-approved words the intense pressure it's facing. They're talking about inflation, stubbornly high interest rates, and just low consumer confidence across the board. These aren't small headwinds, folks. These are macroeconomic storms that directly batter Winnebago's core business, which is selling large, expensive, discretionary items like RVs and boats. This is the essential backdrop you need to keep in mind. We're talking about a tough, unforgiving market that was methodically grinding their entire business down.
And here's what that macroeconomic pressure actually looks like when it hits the bottom line. This is when theory turns into cold, hard cash, or in this case, a lack of it. This is a direct pull from their own financials comparing the first 9 months of fiscal 2024 to fiscal 2025. Look at this. Net income didn't just dip, didn't just soften, it utterly collapsed. It fell from over $42 million down to just $12 million. That is a catastrophic drop of over 70%. This isn't a small crack in the foundation, this is a giant chasm opening up right in the middle of their profitability. A company simply cannot sustain this kind of bleed for long without making some drastic, painful changes. This number right here is the biggest red flag. It shows you just how severe the damage was before this recent quarter. And please, make no mistake about it, this is not a recent problem that just popped up out of nowhere. If we zoom out, the pressure has been building for half a decade. Over the last 5 years, their revenue growth has been essentially flat. I mean flat, which is a total disaster in an inflationary environment where all your costs are rising. But the real damage, the deep structural damage, has been to their profitability. Their operating margin, a key measure of how efficiently they run the business, has been absolutely crushed. It's fallen by 9.1 percentage points. Just think about what that really means. For every single dollar they make in sales, they are keeping 9 cents less than they used to. That flows directly down to earnings per share, which, as you can see, has been in a total freefall, declining at an average annual rate of over 15%. This is the textbook definition of a structurally deteriorating business.
All right. That's enough of the history lesson. Everything you've said is true. It's all in the filings, and frankly, it is all priced into the stock. That profound weakness you're talking about is precisely why a turnaround story, if it's actually real, is so incredibly compelling. The past is irrelevant if management has found a new engine and figured out how to shift into a new gear. What matters, the only thing that matters, is the data right now. And the Q2 2026 numbers tell a completely different and far more powerful story. So let's talk about what's happening now, not what happened last year. Let's fire up the engine of this bull case. Let's start with the headline numbers that shocked pretty much everyone. Revenue grew to $657.4 million. Now, that number might not sound explosive on its own, but you have to understand it completely shattered Wall Street's expectations. The same analysts who modeled this company down to the very last penny got it wrong. And, more importantly, the company delivered on the bottom line, which is where it counts most. Adjusted earnings per share came in at 27 cents. That blew past the consensus estimate. This wasn't a small beat, a little rounding error. It was a clear, unambiguous signal that the operational picture inside this company has changed, and it has changed dramatically for the better. This is the spark. The question is, what lit the fire? And this is the crucial point for anyone who's really trying to understand this story. If you just look at the consolidated company-wide numbers, you miss the narrative completely. You miss the whole point. This was not a case of every part of the business doing just a little bit better. This was not a rising tide lifting all the boats. No. The engine behind this impressive beat was one specific, incredibly powerful segment that just roared to life and started doing all of the heavy lifting for the entire enterprise. Understanding this one segment is the key that unlocks the entire bull thesis for Winnebago. And here it is, the Motorhome RV segment. Just look at that number, a nearly 30% increase in net revenue year over year. Think about that. In an environment where the company itself has been talking nonstop about macroeconomic headwinds and soft consumer spending, one of its largest divisions just put up a growth number that you'd expect from a high-flying tech startup, not a legacy manufacturer. This isn't just growth. This is explosive growth. And we know from the filings it's a direct result of management rolling out new products and their very strategic expansion of their Grand Design brand into the motorhome space. This is the core of the turnaround story. This is the engine. Now, what's really interesting here, what makes this so compelling, is that this isn't just empty, unprofitable revenue growth. We see that all the time. This is highly profitable growth, and that is the sign of true operational discipline. In this same quarter last year, the motorhome segment actually lost $600,000. This year, it generated a $7.5 million profit. That is a massive $8 million operational swing. It brilliantly demonstrates what we call volume leverage. As your sales increase, your fixed costs are spread over more units, and profitability just explodes higher. This is a powerful signal that the turnaround in this division is real, and more importantly, that it has teeth. Okay, a powerful engine is great. I'll grant you that. The motorhome numbers are impressive, I'll give you that. But you can't put a brand new V8 engine in a car that has a rotten, rusted-out frame and expect it to win a race. The engine might scream, but the wheels are going to fall off at the first sharp turn. What good is one strong pillar holding up the roof if the rest of the house is being eaten alive by termites? You're focusing on one glamorous part of the business, but Winnebago is a diversified company. And if you actually look at the other segments, you'll see that this isn't a company in recovery. This is a house divided, with one part surging while the others are actively rotting away. Let's put that high-powered motorhome segment into some much-needed context. Just look at the full-year revenue mix from 2025. Yeah, motorhomes are a huge part of the business at 43%, no question about it. But the towable RV segment, we're talking fifth wheels and travel trailers, is even bigger. It's 45% of all revenue. And then you have the marine segment, which at 12% is still a very significant piece of this puzzle. The point is, motorhomes cannot carry this company alone. It's mathematically impossible.
For the entire structure to be sound, the other two pillars, which represent nearly 60% of the entire business, they need to be solid. And they're not. In fact, they're weak, and they are getting weaker by the quarter. So let's just look at that biggest segment, towables. While the motorhome division was surging ahead by nearly 30%, this segment was going in the complete opposite direction. Net revenues fell by a very painful 9%. That is a significant decline for your largest business unit. And worse, look at the operating income. It fell even faster, down over 12%. This is the exact opposite of the leverage you were just celebrating. It's a nasty little thing called deleverage. As volume falls, your margins get absolutely crushed. So this segment isn't just lagging behind, it's a major drag on the entire company's performance, and it is actively erasing the gains being made elsewhere.
And believe me, it gets worse. Let's turn our attention to the marine segment. We're calling this one taking on water for a very good reason. While the revenue dip of 3% isn't catastrophic on its own, I guess, just look at the operating income. It fell off a cliff. It is down a staggering 46.2%. Nearly half of its profitability just vanished in a single year. The company blames higher warranty expenses and that same volume deleverage we just talked about. Frankly, whatever the reason, this is a 5-alarm fire in a significant part of their portfolio. So what do you have? You have one engine firing on all cylinders, another one that's sputtering and losing power, and a third that's actively sinking. This is not a solid foundation. This is a dangerously lopsided recovery.
You're fixating on short-term operational weakness in these declining segments, but what you're missing is the bigger, more strategic picture of what strong management does in a tough environment. They don't panic, they don't chase headlines, they fortify the entire structure for the long term. A wise builder repairs the foundation of the house before they start worrying about the color of the paint in every single room. The most important story here, outside of the motorhome surge, is what this company is doing to fundamentally strengthen its balance sheet. This is about building financial durability that can withstand any economic storm that comes its way.
And this slide illustrates the point perfectly. Right in the middle of this incredibly challenging macro environment, with 2 of their 3 segments actively struggling, what did Winnebago do? They took decisive, confident action. They redeemed $100 million of their senior secured notes. This is a massive debt paydown. What does it do? It immediately lowers their interest expense going forward, which directly helps profitability. It improves their leverage ratios, making them look stronger and more attractive to lenders. And most importantly, it sends a powerful signal of confidence from the management team to the market. This isn't a company that's panicking. This is a company demonstrating disciplined capital allocation and a very clear commitment to building a more durable, resilient financial foundation for the future. Fortification. Or are they tearing down the seawall just to patch a small hole in the roof? That $100 million had to come from somewhere, right? It didn't just appear out of thin air. And this slide shows you exactly where it came from. Look at their cash balance. In just 6 months, it has absolutely plummeted from $174 million down to just over $47 million. They've effectively drained their liquidity. They paid down long-term debt by sacrificing their short-term war chest. So what happens if there's an unexpected downturn? What if a key supplier has an issue? What if sales in that heroic motorhome segment suddenly slow down? They have very little cash on hand to weather a storm. This doesn't look like fortification to me. It looks like a very high-stakes gamble. Okay, that's a fair point to debate, and it really highlights the different risk tolerances at play here. But ultimately, the best insight into the future often comes from the people who are actually in the driver's seat. So to bring all of these conflicting data points together, let's look at what Winnebago's own management is forecasting for the road ahead. Their guidance is the final and perhaps the most critical piece of this entire puzzle. So here it is. This is the company's official outlook for the full fiscal year. This is the map they've given investors to follow. They are holding their ground. They are maintaining their revenue guidance in a range of $2.8 to $3.0 billion. They're doing the exact same thing for their core profitability metric, keeping adjusted earnings per share in a range of $2.10 to $2.80. Now, they did nudge up the guidance for reported EPS very slightly, but that's mostly just accounting noise. The core operational forecast for revenue and adjusted earnings remains completely unchanged. And this decision, the decision to stand pat after such a strong quarter, becomes the final battleground between the bull and the bear case. And this truly is the million-dollar question, isn't it? If you just had this incredible blowout quarter driven by an explosive surge in your most important growth segment, why on earth wouldn't you raise your full-year forecast? To me, the answer is simple. Management doesn't believe this surge is sustainable. They held their guidance steady because they see weakness ahead, and they know the declines in Towables and Marine are real threats that are not going away.
they are telling you implicitly not to get too excited. But the lead analyst here will tell you it's just smart, conservative management, not overpromising in a tough market. What I see is a glaring lack of confidence. What he sees is prudence. So the crucial point now is to lay out this entire conflict in a clear framework so you can weigh the evidence for yourself. The bull case, the argument for a solid foundation, really rests on three core pillars. First, the undeniable operational and revenue surge in the motorhome segment. Second, the disciplined debt reduction that's strengthening the balance sheet for the long term. And third, that strong Q2 earnings beat that caught Wall Street by surprise. Now, the bear case, which highlights the deep structural risks, counters each of those points directly. First, the weakness in the towable and marine segments is a massive drag on the entire company. Second, that debt paydown came at the very high cost of depleting their cash reserves. And third, management's own conservative guidance signals a clear lack of faith at a sustained recovery. And that leaves us with the final question that you, the investor, have to answer. You have all the pieces now. The decision really comes down to this fundamental belief. Do you believe that the motorhome segment has truly become a powerful new engine, one that is strong enough to pull the entire dead weight of the other struggling segments forward and onto a new road of growth and profitability? Or is this powerful engine just revving loudly, bolted to a weak and cracking frame, creating a lot of noise and smoke right before the entire structure comes crashing down? The answer to that question will determine if Winnebago is a historic turnaround or a classic trap.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.